Just how prudently are your counties spending their finances and accounting for them? Not quite, according to the report from the Office of the Auditor General on the revenues and spending of the counties for the last financial year, which ended on 30th June 2018. Alex Mwangi reports on some of the discrepancies that made the Auditor General give an unfavorable opinion on the accountability of public funds in Kakamega, Nyeri and Laikipia counties.
For Kakamega County, the Auditor General gives a number of reasons for his qualified opinion, which means that the accounting has gaps that are yet to be explained, such as the lack of a register of assets. Total assets are indicated as valued at 7 billion shillings, but he found no assets register either in hard copy or electronic form that was maintained during the year. The Auditor General found a difference of 531.3 million shillings in total receipts between the figures on the financial statements that were submitted for audit and those in the Integrated Financial Management Information System (IFMIS) report. For total payments, the difference between the financial statements submitted and the IFMIS report amount to 22.7 million shillings. The discrepancies bring to question the effectiveness of the IFMIS system at the county level. The Auditor General encountered a similar trend with Nyeri County. Total receipts from the financial statements are indicated as 6.4 billion shillings, compared to the IFMIS report figure of 13.1 billion shillings. Total payments from the financial statements are 6.3 billion shillings, while in the IFMIS report, the amount is 5.4 billion shillings. Similarly, statements reflecting the county's assets and liabilities do not tally. The Auditor General found that pending bills for the county as at 30th June 2018 stood at 360.5 million shillings. He did not find details on how the pending bills for the previous year, amounting to 712.4 million shillings, were accounted for. The Auditor General says that had the pending bills for the last financial year been paid and the expenditure charged to the accounts for the year under review, the statement of receipts and payments would reflect a deficit of 276.9 million shillings and not the 83.6 million shillings surplus indicated. In the Auditor General's opinion, this is evidence that the county's management entered into financial commitments for which no funds were available. Like Kakamega and Nyeri, Laikipia County also got a qualified opinion. Reasons for the qualified opinion include an unbalanced trial balance, which had total debit balances of 29 billion shillings against total credit balances of 28.7 billion shillings, leaving an unreconciled difference of 336.7 million shillings. The Auditor General states that the accuracy and completeness of the receipts generated by the county amounting to 608.5 million shillings for the year under review could not be ascertained. There is also variance between figures from the financial statements and those from IFMIS. These differences point to a challenge in public financial management, with misappropriation of funds through corruption and lack of absorption combining to rob the public of the much-needed services at the grassroots level. Alex Mwangi, NTV.